Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups. Brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I'll just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll just check out how markets are trading currently, and then we'll look at the dollar and a chart on the dollar. Before then, looking at stocks, we'll look at some of the charts on the US major indices and also some of the reasons why we've had such a great rally from those lows post-Liberation Day. So we'll just check out a couple of ideas there, as well as just looking into the rally and how broad that is and what will happen, or what are the key things to look out for going forward for stocks. So just a more in-depth look at stock markets in general because of these record highs that we've been seeing. After that, we'll then go into just last week's main event. So we had some US inflation data, the core PCE data. We heard from Fed Chair Powell, and we had PMI data as well. And then after that, we'll get into this week's main events, of course, which are the non-farm payroll number and also Eurozone inflation data out on Tuesday. Okay, just let you have a look at the disclaimer, which I need for you to do. Okay, here's what I've just run through, really what we hope to get through in the next half an hour or so. Firstly, markets generally, stocks obviously at new highs, which we'll get into. The VIX, that's Wall Street's volatility gauge, if you like, that is down now at 17. What had been trading, of course, just above 20. That's sort of its long-term average, actually, just around there. Whereas the average of the VIX, just for your guide, long-term average just below 20 actually, whereas between 2010 and 2019 actually it was around 17. So we're back there now on that VIX gauge at 17. Otherwise, just checking markets, dollar pretty flat, small down. The yen is outperforming most of the major currencies at the moment. The gold consolidation continues, it looks like. And on the news front, well, we had news that, of course, Trump's big, beautiful bill passed a vote on Saturday in the Senate, basically to allow more time for debate. So we'll get news on that through this week, potentially. We also heard actually about Canada cancelling basically the planned digital services tax because there had been a cessation in trade talks, and PM Carney now hopes that those will resume again. Obviously, we have the July 9 deadline for tariffs, and we'll talk about that through the webinar, actually, and potentially the build-up through that, of course, and then these announcements potentially of trade deals, because, let's be honest, it has been fairly thin on the ground with news of deals apart from the UK one, and then potentially obviously better news around China, around the EU, Vietnam, Japan, but nothing concrete yet. You would potentially think that into July 4th, I think Trump has mentioned there may be news of deals coming forward or being announced even, obviously, then we have that holiday on Independence Day, July 4th as well to note. So non-farm payroll, just for your guide, of course, will be released on Thursday. Okay, obviously I said we'd touch on the dollar first of all. We'll look at the DXY chart when we look at non-farm payrolls, actually. But of course, it has been a really tough first half for the dollar. Some describe it basically as a once-in-generation great rotation, and then the king dollar, if you like. King dollar having its worst start to a year since the era of free floating currencies that began in the early 1970s. as US debt worries grow. Yeah, just a chart giving you the size of this sell-off that we have seen, and obviously then a lot of speculation around, well, the end of sort of dollar as the world's reserve currency, although really that has a long way to go before that could happen. But then, of course, we've had chatter around the euro, the single currency in the eurozone, and potentially moving or stepping up to act as an alternative. And obviously, we've seen this big rise in euro dollar and the sell-off in the dollar versus all its other peers. As I say, we'll look at the DXYs shortly, but obviously this is being looked at generally across the board. We want to probably go to stocks actually now before we look at the dollar and non-farm payroll, of course. Just bringing up a chart here, firstly, of the S&P 500. Just checking you can see this chart. I'll just take off some of the technicals. But yes, of course, US stocks getting all the headlines, grabbing all the headlines because of this rally that we've seen since those lows. The S&P low, of course, at 48.35, you can see there at the start of April. Then this big ramp higher, really. Bit of consolidation around 6,000 and then break of that 61.47 record high from February this year, closing at 61.73 and the high at 61.87. Of course, various reasons as to why we're seeing this rally in US stocks. Of course, we've had geopolitical relief from those Middle East tensions. Amazing if you think about it. Just a week ago, we were gripped by what was happening between Israel and Iran. Of course, markets swiftly moved on really towards the end of last week, obviously with the peace agreement by President Trump, the 12-day war now it's being called, of course, and those tensions have potentially or actually eased significantly. That's reduced risk premiums and helped oil prices pull back as well. Also provides some relief really for inflation expectations and allowed investors then, markets really, to then refocus on fundamentals rather than geopolitical tail risks. So really quite a swift move on from those tensions and really from that fueling this move really above or breaking through 6,000 to those record highs. Of course, we've got kind of trade optimism, I guess, in a way. EU, as I said, nothing concrete really in any trade deals apart from possibly the UK, of course, but it does seem as though the EU, China looking more plausible now than they did certainly earlier this year with some sort of agreement. As I say, the July 9 deadline is looming large, but again, markets really focusing on the taco trade, if you like. So that is, of course, Trump always chickens out, that acronym created by an FT journalist, really, but really on the proviso that that July 9 deadline will be pushed out by Trump so that he can allow for more deals to be announced in the sort of weeks and months ahead, potentially. Certainly, I guess, along with that is the absence of new tariffs, which is, of course, helping boost sentiment across industrials and global supply chain beneficiaries. We've also had, I think it's really important to, as a big reason for this rally, especially recently, is obviously Fed rate cut expectations ratcheting higher. I'll go into these when we look at non-farm payrolls and the sort of exact basis points that we've seen now. But while tariff-related inflation has complicated the timing, Fed remains personally, but really pricing in a soft landing scenario where basically the Fed can ease without the economy falling into risk. And that is a real sweet spot for risk assets. Of course, the US economy is still relatively holding up. We have had surprises to the downside, but also some upside surprises as well. Consumer spending, that remains steady. Labour markets are relatively tight still, considering where we are in the cycle, although they are cooling gradually. And we'll look at non-farm payroll, as I say, in more detail shortly. And really, it's that sort of resilience which is potentially allowing earnings to remain strong, especially in sectors like financials, industrials, and other consumer areas. Just on trade, or just on, yeah, just on trade. Actually, we also had some policy relief, I should say, with this Section 899 removed. If you don't know what that is, markets really cheering that because it's a so-called basically revenge tax from the big beautiful bill, and is a clause that raised concerns among foreign investors about potentially punitive US tax treatment, basically a VAT sort of tax, which the US was going to put on certain countries, and that removal really eases fears of capital flight and really supports potentially going forward continued inflows into US assets. So a number of reasons, really. There are others as well. AI, of course, sort of underpinning support, if you like, for US stock markets, of course. But yeah, those are kind of the main reasons, essentially, for this rally and to new highs that we've seen. Just on the breadth of the markets, interesting that much of the rally's sort of credibility hinges on whether it's broad-based or narrowly driven by, obviously, a handful of the mega cap tech names, the Mag 7, essentially. Generally, this move has been driven by, I think, around 10 stocks, but the market breadth has been improving recently. If you look at year-to-date performance, that suggests, well, widening potentially, because you've got sectors like industrials up 12%, utilities up 9%, financials up 8%. So all outperforming, and that does indicate possibly not just a tech story going forward. Consumer staples, just looking at these materials, are also in positive territory, and they kind of add to the case for a sort of more diversified rally, certainly that we saw in previous times with record highs just being driven by those mega cap tech stocks. Obviously, we still have a divergence because some key pockets of the market are still lagging. So consumer discretionary stocks, they've fallen by over 3% year to date. And then you've got healthcare and energy also underperforming the broader market. So certainly divergence raises the possibility that while the rally is broadening, it's not, of course, yet all encompassing. So going forward, just for stocks then, what's there to look out for? Obviously, there's a tax bill which potentially adds trillions to federal debt ultimately, but it will be watched as it goes through the Senate. Kind of, you've got short-term gains, which the stock market is cheering, but then you've got long-term issues around potentially treasury yields rising, and that might dampen risk sentiment going forward. Then we've got trade deals, of course, as I've mentioned, UK, but then also EU, China, really key for sort of risk sentiment in general, those two latter ones for sure. At the moment, 10% tariffs, of course, but if anything changes to that number and they go higher, then potentially that will impact risk sentiment. Then we've got the Q2 earnings season coming up in a week or so's time. Expected, interestingly, consensus estimates of just plus 2.6% year on year EPS in Q2. That contrasts with, well, is much lower than the 15.1% EPS we saw in Q1. So will be interesting earnings season going forward, and we'll look at that in more depth when we get to it next week or so, as I said. Then, of course, geopolitics still an undercurrent with the Israel-Iran truce peace agreement really holding. Then you've got, of course, China issues potentially, which can be or can heat up as well going forward. So just bear those in mind. Fed independence, of course, is an issue, and that's been an issue for the dollar as well, certainly. And potentially this shadow Fed chairman that we could get as we move into the middle of next year, when Fed Chair Powell's tenure, if you like, comes to a close. But before that, potentially, if Trump wants to name a successor, and he's already touted a few names already, potentially they are more dovish than Chair Powell and will want rate cuts sooner than he has hinted at. Finally, as well, deregulation and tax cuts potentially. We will get more chatter of that going forward. And then, of course, underlying this really is economic data as well going forward, with inflation data still being key. And we'll look at PCE data shortly, sorry, and also non-farm payrolls, employment side. Remembering that the Fed has a dual mandate, of course, maximum employment and price stability. Just on technicals then, finally, we'll get to those. You've got, yes, highs in the S&P 500, not too overbought really on the daily RSI. And I had Keltner channels in here, which are here. If I just put them back and we're just slightly overbought, doesn't mean we can't, as you can see, tap the upper band, so can go higher with bullish momentum, of course. NASDAQ, similar. Similar RSI level as well on the daily RSI, that is, and just tapping now that upper band, but you can just see we've done that previously and we've continued higher, although it does warn possibly of a correction going forward. The Dow is interesting because it's not near those record highs. Record highs in the Dow at just above 45,000. We are above now the 200-day moving average, which is that black line, and that's at 42,581. And we're not overbought on the RSI as well, so potentially a pickup in this bullish momentum could get us closer towards that sort of 45,000 level going forward. Okay, we'll now just check out just briefly last week's main risk events. We had, as I say, Powell on the wires, the core PCE data as well. That's the Fed's favored inflation gauge. So if we just look at that firstly, core PCE, that rose actually more than expected, 0.2% month on month, above the 0.1, an acceleration from the prior 0.1. The unrounded, just for your guide, was 0.1788. That's versus the prior 0.1159. The year on year, that rose to 2.7, so above the 2.6 forecast, while the prior was revised up actually to 2.6 and 2.5%. Headline numbers, they were in line. But it's the core numbers really that the Fed watches, and that hotter than expected print, well, is worth watching really. As I say, it's the Fed's favored inflation gauge, a wider measure than CPI, and it's clearly remaining sticky and above the Fed's 2% target around these levels. Of course, concerns are that the impact of tariffs will start to boost price pressures going forward. Fed Chair Powell, he said they don't expect the Fed to see meaningful tariff inflation effects until the June, July, and August numbers. And of course, if they don't see that, then they would potentially, that would lead to cutting rates earlier. We have had, of course, getting on to the Fed, then last week we had Governor Waller and Bowman, both, that should be noted, Trump appointees. They suggested cutting rates as early as July. That isn't a view shared by the majority on the FOMC, or at least those whom we have heard from recently. But it is interesting, this sticky inflation level above the Fed's target. And there's no sign really of a deteriorating labour market just yet. So it kind of backs really the Fed's stance for waiting and seeing, the wait and see stance, if you like, versus that dovish argument, for acting now, as tariffs are still the unknown. Although potentially, and we've mentioned this in previous webinars, really, potentially now economists and the Fed really seeing tariffs really as a one-off price increase. We talked about that many months ago because that's what happened in 2018, 2019. The Fed looked through tariffs as a one-time price increase, and they were more concerned about growth going forward. Potentially that's what we're going to get, or course, after a lot of economists were very, very worried, should we say, about tariffs having this great big inflationary impact, which is kind of being pared back slightly now. Interesting for us, Wall Street Journal's Nick Timiraos, he highlighted how goods prices are no longer helping actually and have started to contribute to inflation as measured on a 12-month basis. So that's the PCE data, just a little bit hotter, as we've said, and possible cause for concern if tariffs do impact in June, July, and August, of course. Yeah, here's a chart just with those latest numbers, really, and where the Fed funds rate is, of course. Concerning Powell, well, he testified the semi-annual testimony last Tuesday, if you remember. He basically said the Fed is well positioned for the time being to wait to learn more about the likely course of the economy before adjusting policy. He didn't really give a nod to rate cuts specifically, and certainly not like Bauman or Waller, as we've mentioned. But he did mention in the Q&A, actually, a slightly more dovish skew, if you like. When questioned about the possibility of a July cut, he basically said many paths are possible, and he could see inflation come in not as strong as expected, and that if that was the case, he would suggest cutting sooner. Which could potentially lead to a weaker labour market. On the other side, the flip side, because I know that various people focused on that, he did then swiftly off the, if you like, the flip side, because he noted that strong inflation or a labour market could see cuts come later. So nothing too much to be gained from Powell. What he said, it was all pretty much as expected, really. Wait and see stance, as I say. Yes, giving both sides of the argument, although of course he was asked directly about the July cut and sort of mentioned, said what I've just repeated. Kind of in no rush really at the moment. I think he said rates are modestly, not moderately restrictive. So that was Powell and the PCE data. We did have PMI data just for your guide. Out of the Eurozone, still reflecting economic stagnation. The composite just above 50 at 50.2, basically signaling little to no growth. Services did rise, 250 actually bang on. Remember, that's a sort of line between contraction and expansion. Manufacturing still below 50, 49.4. Details pretty weak in manufacturing, actually, while price pressures remain muted. That means expectations for Eurozone GDP pretty much flat quarter on quarter in Q2. And that comes after the 0.6% rise in Q1, but that was obviously driven by front loading of exports to the US. US PMI, just for your guide, declined slightly actually to 52.8 from 53. And then UK PMIs, well, they edged slightly higher due to gains in both services and manufacturing. Services above 50, 51.3, manufacturing still below. So yeah, those were the PMI data from last week. Okay, let's move on to non-farm payroll now. Far more important going forward, of course. And we'll also look at ISM data out tomorrow and Thursday, and then also Eurozone inflation out tomorrow. Firstly, here is a graphic. Hopefully this you like these kind of graphics, just of all the main numbers which are expected. As I say, just remember non-farm on Thursday, not Friday, because of the Independence Day US holiday. So yeah, the economy, US economy expected to add 113,000 jobs now, I think it is. That will change through the week as we get different numbers like the ADP, like some of the ISM data as well. So just beware of that. I think the whisper number is slightly lower, around 105,000 at the moment. As I say, that will again adjust due to the data coming out this week. That goes against, well, the 139 that we saw previously. And just for your guide, just to remember, 95,000 of May's gain actually was netted out by revisions to the prior 2 months. So that actually left a net change of just 44,000. 3 month average, yeah, just above that, so at 135,000. 6 month above that, actually at 157,000, and the 12-month average now at 144,000. Unemployment rate, that's expected to tick a touch higher, 1/10 higher to 4.3 from 4.2. The Fed's latest forecast, actually in June, at its forecast there, the dot plot, and of course the summary of economic projections, that saw the jobless rate rising to 4.5% by the end of the year. And then just on wage growth, that's expected to cool to 0.3%, pretty much what the long-term average, versus 0.4 we saw in May. And then average work week hours actually seen unchanged at 34.3 hours. So bottom line, really, increasingly looking like the labour market is stalling out, most likely, and susceptible to downside risks. We've had other leading indicators like business surveys, job vacancy numbers, and rising jobless claims, all suggesting that probably from July through to September, that's the crucial period, similar to inflation really on tariffs, but that is the crucial period with these leading indicators pointing to softer data going forward on the employment side. Regarding the Fed and the labour market specifically, Fed Chair Powell, he said, well, the labour market remains solid, but acknowledges only very, very slow continued cooling. And that really he does not view as troubling. He cited basically strong job creation and labour force participation as signs of continued resilience. And that sort of sentiment has been echoed by other officials as well. They do, of course, as I've mentioned, offer the usual caveats. If obviously the labour market were to deteriorate sharply, then the Fed would be prepared to step in, but they don't see that at the moment. You kind of think, of course, go with this data then on Thursday, any decent job data, well, will be pounced on by President Trump, possibly as an argument to as to why the Fed should be in an easing cycle. And of course, then if there's any downside surprise, then yes, he'll certainly jump on that and then urge Powell to obviously cut rates again. You kind of think the bar is pretty high to or for the dollar essentially. So we're more likely, if we get a weak number, for the dollar to sell off more than if we get a decentish number, because again, forward-looking surveys and job vacancy data really point to cooling of the labour market in the US in the months ahead. Just on Fed rate expectations, then we are now pricing in around, I think, 65 basis points of cuts for this year. As I've got here, there's kind of a 1 in 5 chance pretty much of a July cut, which was much lower in the last few weeks. And then we've got over a 50% probability of a third cut now, that 15 basis points, if you like. Potentially 60% then chance of a third rate cut by December of this year. So that's non-farm payrolls. We do get ISMs, as I say, just before we look at the DXY chart. Tuesday, we get manufacturing. That's expected to pick up to 48.8, but pretty much remain unchanged. Front-running of purchases ahead of tariffs could still factor, really. And then we need to check out elevated price pressures potentially, which could lead to inflation risk going forward. Then the services ISM, that's on Thursday, expected to rise back into expansionary territory, just I think around 50.3 is the expectation, after briefly dipping below to 49.9. Services activity has remained above 50, apart from that one blip, that recent blip since July of last year. New orders, focus on those, and prices components again, of course, due to tariff uncertainty, potentially affecting that going forward. If we look at the DXY chart, then let me just pull this up. Not looking good, of course. Let me just take off the Keltner channels. You can just see we've still got this descending channel, or at least that downward trend line, if you like, and we just dipped above that before then pulling back. And now we've had consecutive days of selling through that 97.60 level, the recent low, and of course through that swing low from April, that was at 97.92. So yeah, we're now down to, where are we, 97.17 or so. If we just pull it back, actually, you can see that bear channel, of course, lower series of lower lows, lower highs, and there's not a lot of support, really, you have to say. This is now the monthly chart, and you're kind of looking at where support is, really. So interesting whether we do hold below the 97.60 level, and then potentially we can drop a lot lower with this daily RSI in no ways oversold either. Okay, we'll move on to Eurozone inflation data. So we're just pulling up the euro dollar chart here, which is here. So I always say this, but the dollar index, of course, is an index against 6 of its major trading partners. By far the biggest weighting in the dollar index is the euro, around 56% weighting. So if you turned the DXY chart on its head, which is here, then you pretty much get, of sorts, the euro dollar chart, and you can just see consecutive days of buying through that previous high at 116.31. We got up to 117.50 earlier today, which is a high for the move after, well, no, sorry, Friday was the high, 117.53. So just on Eurozone inflation data, expectations are for the headline to hold steady at 1.9, and for the core to tick lower, actually, by a tenth to 2.3%. The May data, well, that fell from 2.2 for the headline to 1.9%. That was actually below target for the first time since September 2024. Core inflation, that fell then from 2.7% actually to 2.4%. And services also had a notable fall, actually, from 4% down to 3.7%. This time around, well, expect further moderation from an easing in services, actually, as well as in food price inflation, although that could possibly be slightly offset by movements in energy and goods prices. The latest services inflation from May, actually, just to note, that was also disproportionately weak. So a slight increase actually could be in the making this time around. Ahead of the Eurozone, the sort of region-wide release, we've seen French inflation that rose actually to 0.8 from 0.6%, and Spanish that advanced to 2.2 from 2%. And then from the ECB's point of view, well, given the ongoing appreciation, so the rise in the euro, a soft release then could heighten calls for the ECB to ease further this year. But markets aren't fully pricing in another 25 basis point cut until early next year. So price for there is room for a big repricing there if we do get a soft release. Of course, with this ongoing appreciation in the euro. Also, then, I guess, apart from the ECB, then we should take in mind any movement on trade deals. We have had, probably the latest comments from US Commerce Secretary Lutnick have suggested actually that a deal with the EU could be announced by the end of this week. So yeah, just bear that in mind as well, potentially affecting the euro and also the dollar, of course. Just for your guide as well, moving away from inflation, we do get the annual ECB forum actually in Sintra in Portugal. This has historically been where we have seen some big announcements by the ECB, also by other central bankers as well. That is starting tomorrow. It will be interesting. We'll hear from ECB Chief Lagarde, obviously. I think also Powell as well, whether they give us any clarity on kind of the geopolitical turbulence, also on policy going forward, with potentially any clarity on the economic impact of course, Middle East tensions, and then also, of course, the July 9 tariff deadline. Any hints on ECB policy obviously will be seized upon. Also, Powell potentially in the spotlight with Trump, of course, as I've said, naming his successor potentially early. So fanning those worries over Fed independence. We also could hear about the results of the ECB strategy review as well. So potential impact on euro and euro dollar. But a busy week ahead. Of course, a shortened holiday week for most, or especially those in the US. Markets, of course, closed on Friday in the US, but open elsewhere. But liquidity will, of course, be thinner. Okay, I'm going to wrap it up there. I should have said, I do apologise. If you do have any questions, please ask them now. Apologies, should have asked them along the way. Anything we just talked about or anything you're looking at, please do ask any questions in the chat box. Really great turnout today, actually. So really do appreciate that, holding on for over a half an hour or so. As I say, it's a weekly webinar, but please also do follow us on social media. And also, I should say, we do have a daily market report that we put out on the website every day after the US close. So that has a look at the dollar, US stock markets, and also a more in detail look at the day ahead, and then a chart of the day as well. Okay, no questions. Apologies for that, giving you only a short time frame to ask questions. But yes, really do appreciate you on the call. We will be back same time next week to review non-farm payrolls and look ahead to obviously the tariff deadline as well. Do join us then, and we will speak to you soon.